Hey guys, this is a market update. So much is telling us right now that there's going to be a recession within the next 3 to 6 months. So let's have a look at that data and how the market is going to react to this and how I'm trying to play things right now. So within this green box is the next 3-5 months. All the data is showing us that a recession is going to occur. So, a typical recession with joblessness and GDP coming, negative, right? Month over month, quarter over quarter to the downside. This is a bit of a mess here. As you can see, CPI figures are coming out in each of these months around the first week or so. So around the 12th, 13th of January, and then these CPI figures. Now, CPI is coming in way under expectations, which is actually good news for the most part. But the Fed and other central banks kind of don't care about this anymore. What the Fed have said really is that they're focusing on employment because that's where they see the most sticky inflation. So what they're basically saying is we're going to raise rates and keep them high until a large portion of the population lose their jobs, essentially what they said. Really bad news, right? Bad news for the economy, bad news for people, bad news for risk assets. And so I don't see any reason at all why at the start of the new year, we're suddenly going to be getting higher highs and higher lows for Bitcoin and starting a new uptrend. Absolutely no reason at all. We have to get through this entire mess right here over the next 6 months of another rate hike probably in February, which will be 25 and the last one. And then these jobs figures, which are going to tell us how fast the recession is coming. So within this next 3 to 6 months, I think you'll just see weakness, to the downside, consolidation at best, right? No reason for anyone to start buying any risk assets here in terms of institutions and everything like that. A lot of them are just sitting on the sidelines with the most amount of cash that they can possibly hold, maybe buying other things that are not risk assets. But within this 3 to 6 months, the entire situation could change and flip. The risk is when a recession starts, when joblessness starts ticking up, how's the market going to react? So it can't be positive, right? It's going to look forward and try and price in the flip. But the uncertainty is so high that if you're looking just from a general perspective, no one's going to start really piling into these assets until they know for sure that the Fed has kind of done everything and then it can flip. But if we look at some other data as well, if you are a trader, deposit bonus on Bit get up to 8,000, 0 commission spot trading right now as well. So if you're an investor, you can buy it on there for 0 fees and then take out to your wallet. As you can see right here, the unemployment rate's still low. And this is what the Fed are saying right now. We're not going to change anything until this ticks up. And so when you start to see it ticking up, then you can start to think about the Fed really having massive pressure on them to stop raising rates. And they've said we're going to be higher for longer. But this is all nonsense, right? This is all just Fed talk. They're going to raise until this starts to tick up, until people start to lose their jobs. It's happening now. You can see the news headlines. You can see joblessness in the tech sector, finance, some other kind of more blue collar tech, which is not really the high metaverse stuff, which is obviously the first stuff to go. But like Micron letting people go, saying they see a terrible outlook, right? So these kind of companies that aren't high-end metaverse stuff, they're starting to really feel the heat now. And so you're starting to see this happen in the news, but it's going to take a while to filter through. Once the official figures show this ticking up, the Fed are absolutely done. But it's going to be pretty rocky in the meantime. As you can see here as well, this is the non-farm payrolls. And as you can see, as they tick down, so this is joblessness going up, you can't see the gray here, I think, but it's in 1990, you have the 2000 here, and then you have the 2008. As soon as joblessness ticks up, that is the recession, right? And that is when the Fed flip. And as you can see, it just matches here. So the Fed raise, pause, and then cut significantly. Raise, pause, cut significantly. And right here, this is insane, right? This is what they're doing now. They're going to be raising and almost raising into joblessness. Now, that does not happen. And so I just don't believe that they're going to keep rates high when joblessness is ticking up. And so I think the jobs rate is the thing to be looking for. Unfortunately, it's not that tradable because with joblessness ticking up, you have, the economy falling apart. And so the Fed are going to keep on with their hawkishness, really to just drill home the fact that they're working on inflation. They will flip eventually. But jobs ticking up is really the start of the end for what they've been doing with, rate hikes and trying to be hawkish on the economy. There's just nothing to do after that point. We also have a bunch of forward-looking indicators showing us when the recession may occur. So this is Macro Alpha right here with a Conference Board top 10 leading indicator index. So he says year-on-year change when it turns negative for 2+ months in a row, it has a 100% hit rate on anticipating recessions with a average 7-month lead time. So an average would be around March 23, could be a little bit before or after that. So that's really when you're looking at the actual recession starting. And really at that point, it's just a matter of how the Fed reacts, right? So trying to understand how they're going to react. Are they going to be very soft? Are they going to try and support the economy and the market sooner? Or are they not? Because if they don't, then you're just going to get rampant sell-offs in the stock market for sure as well. So it's interesting to see how they're going to play this one. We can also see this right here. This is leading economic indicators, and you can see that it predicts recessions every time, right? So you have the 6-month growth rate in blue right here, which is giving us the same indicator that we got in the 2000 crash and the 2008 crash and the COVID crash as well, which they sorted out very quickly in terms of the Fed. This time, they're not going to do that. I believe they're going to step in, but I don't think they're going to do what they did during 2020, right? I think they're going to step in a little bit, try and shore up the economy, but I don't think they're going to support growth at all. I think they are going to, as they've said, accept a period of below trend growth. That was what they said. So I believe that even though they will step in, I don't think it's a massive new bull market like we saw in 2020. But they're going to have to step in at some point if they don't want the whole thing to crash. As we can see here as well, in 2023, this is the global liquidity index. And as you can see, this is just a cycle. It's a cycle that goes over and over and over again. We're at the bottom of this cycle right now, and 2023 would be the turn of that cycle. Makes sense, right? If you have a recession coming, let's say towards the start of the year, or if joblessness ticks up enough where the Fed say, you know what, we're kind of actually done at this point. And remember, all of those economic indicators are still going to be getting much worse, even if the Fed pauses, right? They started raising rates 12+ months ago, and inflation's kept going up for like 10, 12 months. So even if they stop raising now, the inflation, joblessness still going to be going in the wrong direction for them, or the right direction, I suppose, if you're them. But as we can see here, this is like it takes us 6 months a year to kind of bottom out and then start on the liquidity cycle again. And so 2023 is the year where you could actually time this really well, and move into going long into the refresh of the liquidity cycle going up again. So really good chart to show these kind of longer term trends, right? I think it's much easier to try and time these longer term cycles rather than try and predict prices over 3 to 6 months. So very difficult getting in at this stage. A lot of volatility, a lot of potential downside, but around this time, what you're doing is kind of buying the bottom of the cycle. Maybe not the bottom price. You can't predict the price. It can maybe fall another 50% if the Fed, really want to turn the screw. But you're trying to maybe time the bottom of a cycle. This kind of shows it as well, as you can see here, the Bitcoin price over the long term with a moving average, 2-year moving average, and then a two-year moving average times 5 to give kind of a lower and upper bound. So again, like really simple. Do you want to be buying and going long at the end of a bull cycle, which is when the price actually breaks through that moving average bound, right? The upper bound. These are typically the worst times to be buying, when it moves up there. And instead, the best time to be buying, typically on this chart anyway, has been at the kind of bottom of a cycle. So in 2015, that bear market, then we have this bear market in 2019, and then this bear market right now, which is one of the worst bear markets, which makes sense because not just is it a Bitcoin cycle, you now have more of a macro cycle priced in as well. So when you're looking to go long, you're looking at, if you have a few year time horizon, to obviously time these bottoms. And as you can see, they last a while. And so you're not going to time the bottom very well, but you have a much better hit rate of actually trying to go long during the bottom of a cycle, and then have a maybe 1 or 2 year wait for the next cycle up. If you are looking to buy a Bitcoin and you're looking to accumulate Bitcoin, then you avoid these times up here where we go above the chart, and you do pick up around these times. Yes, the price is going much lower, but it's just a timing thing at this point rather than trying to predict prices all the time. So this next 6 months is absolutely vital. The Fed could help us out a little bit, or they might not. And so we may get some kind of real bad results in the first quarter, earnings coming down, bad sentiment, joblessness ticking up. And I don't know how the market is going to react to that, whether it's going to price in kind of the flip from the Fed or whether it's just going to get a lot worse. Unpredictable, but what is predictable way more is that we are towards or in the bottom of each of these economic, as you can see here, and Bitcoin cycles right now. So take that for what it is. If you are an investor, you can get 0 spot trading fees on BitGet right now. So use 0 fees and then take it out to your wallet and hold it in cold storage. Link in the description for that bonus as well. I'm James with Money's EG. Cheers for watching, and I'll see you in the next one.